When you boil it all the way down, there are only 3 ways to make enough money to call yourself wealthy, and they're all pretty straightforward and easy to understand. It's the execution that makes them difficult to achieve. So in this video, we're going over these 3 ways, how they work, what makes them difficult, and why people usually fail at them. Welcome to A-Lux. Now, most wealth is created the moment something new comes into existence, so the first path to wealth is simple to state and brutal to execute. You build it. You create a value-producing machine and you keep up the equity. That's it. The majority of self-made billionaires are founders. According to multiple global wealth reports from firms like UBS and Forbes, the dominant category among new billionaires over the past 2 decades have been self-made, with entrepreneurship as the primary driver. Technology, manufacturing, retail, logistics, energy, different sectors, the same mechanism. They built something, they owned most of it, and it scaled. And scaling is the key here. Income has a ceiling, ownership does not. If you earn $300,000 per year, that income grows linearly. Even if you double it, it is still linear. Your output is tied to hours, leverage, or negotiated compensation. But if you own 60% of a company that goes from $1 million in revenue to $100 million, your equity does not grow linearly. Valuation is not based on your effort. It's based on revenue growth, profit margin, market dominance, future expectation of cash flow. That's why founders often look overpaid. They're not being paid for labor, they're being paid for control over a scalable asset. When a SaaS company grows from $2 million annual recurring revenue to $20 million, its valuation might move from 4x revenue to 8x revenue. That's not 10x growth, that's 20x equity repricing. That's the moment wealth appears. So here's how to build a path that actually works in economic terms. Step 1. Identify inefficiency or unmet demand. Step 2, create a repeatable solution. Step 3, standardize delivery. Step 4, scale distribution. Step 5, retain ownership during scale. Most people fail at step 5. They either give away too much equity early on, they fail to formalize systems, they build a job instead of a company, they never reach distribution scale. A business becomes a wealth engine only when it detaches from the founder's personal labor. The real leverage in building is not product, it is distribution and margin control. A mediocre product with superior distribution can dominate a market, but a superior product with no distribution dies. High gross margins allow reinvestment. Reinvestment fuels growth. Growth increases valuation multiples. Multiples create equity wealth. It's a loop. Build, sell, reinvest, scale, reprice, repeat. However, most startups fail. Depending on the data set, a large percentage of new businesses don't survive beyond 5 years. And venture-backed startups have an even higher failure rate because they swing for scale. But the upside is asymmetric. You can lose your time and some capital, but you could gain generational wealth. The payoff distribution is not normal, it is power law. A few outliers return everything. That's why this path attracts extreme personalities. But what people get wrong here is they think building is about passion. It is not. It's about structural leverage. You're not building a cafe because you love coffee. You're building a repeatable system that produces predictable cash flow at scale. If it can't scale, it won't make you rich. If it can't detach from you, it won't make you rich. If you don't retain equity, it won't make you rich. You must own a large enough piece of the machine for scale to matter. Owning 2% of something growing moderately rarely creates transformative wealth. Owning 60% of something growing aggressively often does. Ownership percentage multiplied by valuation is the formula. But what about timing and market selection? Well, building in a shrinking market is uphill. Building in an expanding market compounds effort. Many founders were created not because founders were geniuses, but because they entered expanding systems. Think internet adoption in the early 2000s, mobile ecosystems in the 2010s, cloud infrastructure, or AI and semiconductor demand. When a market expands, even if your business ain't that great, timing alone can push it far enough. Then there's also a psychological cost, because this path requires a tolerance for uncertainty. Income is unstable, identity is unstable, feedback is pretty brutal. You're exposed to market forces daily. There's no salary cushion unless you create it yourself. This is why many people prefer stable employment. The emotional volatility is just lower. But volatility is the price of equity. You don't get ownership upside without enduring risk exposure, and not everyone is cut out for it. But if you are, we would love to see you inside the Alux app, because that's where you get the inside scoop on how these processes work, especially the next two. On the inside, we have an expert-led collection all about private equity. Not building the thing, but buying the thing, which we're about to explore next in our discussion. We've got Aram Tagavi going deep on this topic, giving you millionaire mentorship for the cost of a nice dinner for two. You can download the app for free at alux.com/app. Even better, scan this QR code and get 25% off your annual membership. I'll see you on the inside to go deeper on this stuff, but in the meantime, let's get back to discussing the only true ways to become wealthy. The second one is to buy the machine instead of building it, because not everyone builds the factory, some people buy the factory. This one is not about creation, it's about acquisition. You allocate capital into productive assets that already work. Then you let time, cash flow, and compounding do the scaling for you. Now, most long-term wealth compounds through ownership of productive assets. Historically, broad equity markets have returned roughly 7 to 10% annually over long periods, depending on geography and the time frame. Real estate has generated a combination of rental yield plus appreciation. Private equity funds, on average, have targeted higher internal rates of return, though with higher risk and illiquidity. So if you own shares in a profitable company, that company operates regardless of whether you show up or not. If you own rental property, tenants pay regardless of whether you personally swing the hammer. Ownership decouples wealth from effort. This is the structural shift. The investor path is built on one idea: productive assets compound. Compounding means returns generate additional returns. If you invest $100,000 at 8% annual return, you earn $8,000 the first year. In year 2, you earn 8%, not just on $100,000, but on $108,000. Over decades, that curve bends upward. It looks pretty slow at first, but then it accelerates. Time is the hidden multiplier here. Now here's how the ownership path actually works in disciplined form. Step 1, accumulate surplus capital. Step 2, allocate into productive assets. Step 3, reinvest cash flow. Step 4, repeat consistently. And Step 5, avoid catastrophic loss. So, what counts as a productive asset? Well, a productive asset generates either cash flow, appreciating value due to underlying earnings, or both. Some examples could include public equities, ownership in companies that generate profits, real estate, rental yield plus land appreciation, private businesses, direct ownership stakes in operating companies, private equity and venture funds, pooled capital deployed into growth companies. Even index funds qualify here. You're buying a slice of aggregate corporate earnings. What doesn't qualify? Pure consumption assets, speculation without cash flow, assets that rely solely on greater fool appreciation, meaning you're buying something that has zero value hoping that someone will buy it from you at a higher price. That's pretty much like those ape NFT profile pictures from a couple of years ago. If it doesn't produce value, it does not compound sustainably. And for a moment, let's look at the mathematics of compounding, but we'll keep it simple, don't worry. Say you invest $20,000 per year at 8% average annual return for 30 years. You don't end up with $600,000. No, you end up with significantly more because each year's growth builds onto the previous base. The acceleration is nonlinear. The early years feel pretty insignificant, but the later years feel explosive. This is why the investor path rewards an early start more than extreme intensity. Consistency beats brilliance. The time horizon here is everything. Building wealth through ownership requires duration. 5 years is short, 10 years is medium, 20 to 30 years, that's powerful. Short time horizons push people towards speculation. Long time horizons favor compounding. This is why many investors underperform markets. They interrupt the process. They buy high during optimism. They sell low during fear. Emotion is the enemy of compounding. Systems beat emotion. But what people get wrong here is they think investing is about stockpiling brilliance. It is not, okay? It's about disciplined capital allocation over long time frames. The majority of investor wealth historically has come from broad exposure to growing economic systems, not from predicting the next short-term move. The real edge is staying invested, reinvesting dividends, avoiding catastrophic loss, and scaling contributions over time. Ownership rewards durability. You don't need to invent the next global company to get rich. You need to own pieces of productive systems and allow compounding to operate uninterrupted for long enough. You're not designing the engine, you're buying equity in engines that already run. Now, this path is slower than building in early years. It's often more stable. It requires less operational chaos, but it still obeys the same rule. Wealth flows to ownership. If you do not own productive assets, your effort enriches someone else who does. And then there's the third way to get rich. Join in, enter the system, then convert income into ownership. Because not everyone starts out with capital. Not everyone wants to build from zero. The third way to get rich is the bridge path. You enter an existing high-value system. You position yourself where leverage concentrates. You extract outsized income. Then you convert that income into ownership. High earners disproportionately cluster in leverage-heavy industries: finance, technology, law, enterprise sales, energy, corporate executive leadership. In many developed economies, the top 1% income thresholds sit multiple times above median income. In the United States, for example, entry into the top income percentiles requires several $100,000 per year. In major European capitals, the multiples are similar relative to median income. Now look, okay, labor by itself does not scale well. We established that already, but labor embedded inside of high-leverage systems does. A software engineer building tools used by 10 million users creates more economic value than one writing internal scripts for a small local firm. An investment banker structuring a $2 billion acquisition earns more than one advising small private transactions. Compensation follows the scale of impact. And this path has 5 phases. Phase 1 is skill acquisition. You develop a scarce, economically valuable skill. Not a hobby, not something trendy, something that drives revenue, reduces cost materially, allocates capital, or manages risk at scale. Scarcity creates pricing power. Phase 2, system selection. You choose industries where value multiplies. Technology platforms, financial markets, global enterprises, capital-heavy sectors. A strong skill in a weak system caps income, but a strong skill in a scaling system expands income. Phase 3 is proximity to capital. You move closer to decision-making, closer to deals, closer to equity grants, closer to profit pools. This is where many people stall. They remain operators without negotiating upside. High earners who become wealthy negotiate stock compensation, profit share, carried interest, performance bonuses tied to enterprise value. This is the inflection. Phase 4, aggressive conversion. You convert income into assets immediately. Not after lifestyle inflation stabilizes, not after the house upgrade. Every bonus becomes equity. Every stock vest becomes diversified asset allocation. Every windfall feeds compounding. And phase 5, detachment. Eventually, your assets generate enough return that labor becomes optional. That's the exit from the control path into the ownership path. If someone earns $400,000 per year and lives on $120,000, they can deploy $280,000 annually into productive assets. Compounding on six figures behaves very differently from compounding on five figures. The slope steepens. This is why many high net worth individuals begin as specialists before transitioning into owners. Now, all of these three paths have different types of difficulty. Building something requires you to, actually build the thing, which is probably the hardest thing you could do. Buying something requires you to already have enough money to begin with, and joining into a system where you get paid in equity alongside salary requires you to, 1, be really good at your job, and 2, at the right place at the right time. But, if it